S&P 500 profits are up 12% year over year, and wages are up 4 to 5% a year. That's not sustainable. All of the improvements in the economy, what's contributing to GDP and corporate profits, is AI CapEx, and that inherently is benefiting a small number of companies and a relatively small number of people. Like, you see the headlines about people being paid literally $1 billion to join Meta to be an AI researcher. This episode is brought to you by Fiscal AI, the fastest growing stock research terminal on the internet. You'll hear more about Fiscal later in the show. Let's get into it. Got no guest for today's episode of Monetary Matters. I'm joined by my friend and business partner, Max Wiethe. Max, good to see you.
It's good to see you as well, Jack. We've had a big couple of weeks for economic data as well as some huge moves after earnings. I know we're going to get into all of that. Where do you want to start?
Well, Max, this week we got the inflation report. I'm going to get into that into a second. But first, I just want to note just how easy financial conditions are in the United States and really around the world as well. But the S&P 500 is at an all-time high. It's made that day after day. It keeps on going higher and higher. Credit spreads are near their all-time lows. This was a Bloomberg article about how in the loan market, loans are being priced at a spread that is considered basically the lowest level possible, except now it's an even lower level. That's different than the high yield bond market, of course. And yeah, it just seems like you're getting story after story that is just about how easy financial conditions are, and particularly like Nvidia's up today, even though that you had China supposedly announcing that they were discouraging companies from buying them. So it seems like good news is good news, and bad news is good news as well. The Van Eck Semiconductor Fund on Tuesday, every stock is up in that ETF. So very easy financial conditions across the board. Max, this week's inflation report on Tuesday, it was roughly in line with expectations. So for headline, it was 2.7%. The consumer price index increased year over year versus 2.8% expected. And then for core, it actually was slightly above expectations at 3.1%. But if you look at those month over month figures, it was roughly in line. And so the way that the rates market interpreted it today is that this gives the Federal Reserve license to cut interest rates in September at their September FOMC meeting. Going in today, I think it was about 90% chance that they were going to cut, but this inflation report kind of sealed the deal, and it's now an even higher percentage chance. So it is far away. It is more than a month out, but typically, when something that's 95% gets priced in at a 95% likelihood, that usually happens. I actually can't remember a single time that it hasn't happened when the likelihood has been that high. But again, it is coming out. So it's looking like the rate cutting cycle is going to start in September, and financial conditions are easy, Max.
To put into perspective, a month ago, so on July 11th, it was 57.4%. Actually, I think data over the last couple of weeks probably moved things more, and that was the big revision downwards in the labor market. The actual jobs print wasn't too, the new month wasn't too scary. It was the revision down in the previous two reports. Obviously, we had the head of the BLS was fired over these revisions. And I think that probably did most of the heavy lifting on the rate cut front. Are there any data points looking forward that you think could shake this confidence in a rate cut?
Well, let's see, Max. There's the PCE index, which is another reading of inflation, but it's actually the reading of inflation that the Federal Reserve officially measures. That's the 2% target for inflation is the PCE reading for the Fed. That will come out at the end of August. And then there's the August jobs report, which will come out in early September. So those would be the two things that first come to mind. But I think they'll probably influence the rate expectations going forward. Max, one thing I want to talk about is just we're close to the end of earnings seasons. Basically, every big company, that matters has reported, with the exception of Nvidia. Every U.S. company, I should say, of course, and they really have beat across the board. Going forward, Max. I remember in March and April, people were talking about how earnings expectations for Q2 were priced for perfection, and how it was just everything was on a knife's edge because everything, companies had to just over deliver so much, and because people expectations were so high. But actually, they were pricing in something like 6% earnings growth, year over year. And then I think those ticked down later after the whole, market crashed in April to maybe like 5%. But the actual year over year growth for S&P companies, I think roughly 90% of which have reported so far is is 11.8%. So that's 11.8% earnings growth. So you just, people talk about how expensive the S&P 500, and it is on a historical basis. But if earnings are growing at 12%, a price to earnings ratio of 22, let's just say that's implied earnings yields of 4.8%. That's basically where the 10-year is, except the 10-year doesn't grow and the S&P 500 does. Now, of course, there should be an equity risk premium in there because stocks are risky and the bond market is safe. But it just, I mean, I don't know, Max. I mean, if I feel like every single quarter companies just crush, and then the US government is issuing so many bonds. So maybe the bond market is less safe than the stock market. That's not something that I actually believe, but I think it's something that maybe the stock and bond market, investors worldwide are considering just based on how low the equity risk premium is. I don't believe it is actually negative like it was in 98 or 99, but we definitely are breathing rarefied air. But look, if earnings grow 12% a year every year and there's never a recession, then of course, the stock market is not too expensive. But there will of course be a recession eventually. But it's been predicted for 4 years, Max, and it hasn't happened.
Yeah, and I'd actually like to juxtapose that with the economic data. Obviously, the revision downward in the labor market, not good for Main Street, for everyday people. Inflation, despite not being like a hot print, it was below expectations. I mean, we're still not at target. There's some aspects of inflation. Tomatoes are catching stray bullets from people talking about how high the tomato inflation is going. There's questions as to whether that's tariff induced, whether that's labor market induced, as obviously the immigration policy could be affecting, U.S. production of vegetables and things like that. Not that tomatoes are particularly important economically, but certainly, Trump ran on I'm going to get grocery prices down. It's something that people are keenly focused on, and so there does seem to be a strong gap building here between Wall Street, driven by this huge earnings growth, and Main Street on the other side, which is having persistent, sticky inflation, not nearly as high as we saw in years past, but still above target, and a labor market that is weakening. And, when you talk about these easy financial conditions, it would be if you were to talk about how financial conditions were and then say, "Oh, yeah, and the Fed is about to cut 25 basis points." If you didn't know all of these other things that are going on, you would be surprised at that.
That's true, but inflation is looking like it's approaching the Fed's target. And actually, yeah, I mean, why should the Fed cut? I guess the Fed should cut because the labor market is weakening. The Fed would say softening, not weakening, but maybe it is really weakening, and maybe softening is just too polite, too euphemistic a word. I don't have the data in front of me, Max, but yeah, the job the July jobs data from a week ago or 2 weeks ago was quite bad. And it was, as you said, those revisions in those earlier months to the downside, basically showing that the employment is uh, not keeping up with the replacement rate. So the demand for labor is going down a lot, or the growth rate for demand of labor, but the supply of labor is going down as well. Um, I do think, Max, this whole tomato thing, it was mentioned on Bloomberg this morning, that the price of tomatoes is going up, the price of lettuce is going up because of that's from tariffs. Well, first of all, I think the fundamental, if there's any volatility in tomato prices other than the weather and just normal prices, I think it's tariffs from mainly Mexico, I would say, but also immigration change policies as well. So those two things could have a fundamental price, but that really is just speculation, Max, because I reported today. So like tomato prices went up 4% month over month, not year over year, but month over month. Excuse me, tomato prices went up 3.3% month over month, and lettuce prices went up 4%. So that sounds like it is a big deal, and it is a big deal. Obviously, if lettuce and tomato prices did that every uh, every month, then they would go up 60% year over year, and it would be unsustainable. But you look at the prices of tomatoes and the monthly changes, and they are extremely volatile. So, for example, in January 1990, tomato prices went up 90%. I looked it up because there was a storm. That's the reason why I looked it up. But so actually, if you take the average change in admittedly non-seasonally adjusted tomato prices, the average monthly change is 8.5%. So the 3.3% move from month over month is actually less than half the average move. So I would respectfully disagree with the Bloomberg analysis, the analysis on Bloomberg TV today, that the tomato price change is a empirical sign of tariff inflation. It could be coming. The prices of tomatoes could go up 40% over the next few months because of immigration changes and Mexico tariffs and everything. But I'm just saying I don't believe it's true that we've seen it in the data. So that's my tomato tirade.
Okay. Now, what about on the earnings front? Everybody was saying that everything was priced for perfection, but we were taking a look at this earlier today, and actually, earnings expectations had been revised down. Now, we had a big step down sort of right around the end of October and November last year when it started to become more clear that Trump might win the White House. People started revising down their earnings expectations, knowing what his policies were likely to be. Then you had, okay, he actually delivers on that around Liberation Day, and earnings expectations had another sort of step down. And then they have been creeping back up, but they're nowhere near where they were when they peaked back in October, at least for this quarter. And for a lot of companies, they actually came in above what those October expectations were. So, is it really right to say that the market was priced for perfection coming into this?
You are right, Max. The S&P 500's earnings expectations did peak at the end of last year. So earnings expectations were actually already going down going into this year, and they continue to go down into about April, which is when we had the market crash. We're going to look at some individual companies later, but I think that they definitely were priced for optimistic growth. But again, 12% earnings growth year over year is really, really phenomenal. The number of beats, Max, I think about 81% of companies that have so far reported in the S&P 500, 81% of them have beat their earnings expectations. And I want to give context here, Max, because you know it's implied Wall Street is a game, and Wall Street plays this game where the earnings are too low. So I think roughly the average beat rate is like 70%, but 81% is higher than normal.
Another metric that people looked at was the implied move of options, that we saw more volatility than the options market had priced in. So, despite this being a game that people play, if you would say the insiders of that game are the hedge funds and traders who might be playing some of these earnings prints in the options market, the expected move from options was actually lower than the actual moves, which is pretty rare. Because if you would say everybody knows that this game is happening, and so the options market kind of sniffs that out, we didn't see that this time.
Right, and companies that actually didn't do well, the few of them that did, those stocks absolutely tanked, at least the days of the earnings. So, later on we'll talk about Amazon that actually had, it beat revenue, it beat earnings per share, but there was some fuzziness on cloud demand and on the outlook. So that stock went down a fair amount the day of. It has done quite well since. So I'd say companies are being penalized for their bad results. Um, I might say Tesla could be a potential exception to that, but overall, I say companies are up because the fundamentals are up. So I would take exception to the claim that the stock market is up only because it's a bubble and because of speculation. I think we're beginning to see some of that, but really at the heart, the core of this bull market is the dominant companies, that the Mag 7 and other high quality companies, and their earnings are up and to the right, as they say.
What are a few companies you want to start with, and then we can finish with Amazon, which is maybe the exception to the beat and rip rule that we've seen this quarter.
Well, Max, let's start with Apple, and I want to give a shout out to our partners at Fiscal AI. Simply an incredible tool, just for really understanding fundamental drivers of companies, of stocks, and we're going to look at their earnings expectations, how they compared to the actual earnings, and then how those expectations themselves have been changing over time. And I think we're really going to paint a very interesting picture. So, Apple, as many viewers know, Max, has been kind of viewed as a dog when it comes to AI. Okay, they've got the basically monopoly on high quality iPhones and stuff. They have the services business. Okay, we got Warren Buffett in the stock. Oh, Warren Buffett selling. But really, what is the tailwind from AI for Microsoft and particularly Nvidia? It's obvious. But for Apple, how is Apple going to benefit? I think the revenues had been flat to down for a few years, so certainly not a growth stock that would merit a 30 times price to earnings ratio, right? But okay, so even Apple, they beat on earnings, $1.57 versus the $1.43 that was expected, and $94 billion of revenue versus 89 that was expected. And so those tables we can put out on screen again, thanks to the partners at Fiscal AI. But particularly, I want to look at the Apple earnings per share estimates and how they changed over time. The light orange line, earnings per share expectations peaked in the summer of last year, and they have been declining since. Again, this is the AI dog summer of 2024 when Apple just could not get any love. Warren Buffett, I believe, was selling during that time. But you see the orange line stops, and suddenly you see an absolute pop in the blue, turquoise, and dark orange line. Those are the earnings per share estimates in the future. So the fact that Apple just crushed expectations, and I think they had good guidance as well. Now, future expectations go up as well. Let's just take a pause, Max, and look at Google, a company that I certainly have been bullish on for a while. And let's just keep it simple. Look at the fiscal years instead of the fiscal quarters. So this chart is way less complicated, but you look at fiscal 2023, earnings expectations went down and down during 2022, and they bottomed in about January of 2023. Interesting, that was actually the bottom in the stock. And then you have a relentless rise in earnings per share revisions and estimates. In 2023, they went up. 2024, they went up. 2025 went up. 2026, they went up. So you really see the market has been climbing here. The earnings have been going up. The earnings per share expectations have been going up, and the stocks have been going up. Fiscal AI is the fastest growing stock research terminal on the internet. They combine a modern user experience with complete financial data on all stocks globally. Not only does that include 20 years of standard financial statements, but they also track company specific segments and KPIs on over 2,000 companies.
That's right, Jack. Want Amazon's cloud revenue? They've got it. How about Spotify's premium subscribers? Or segmental analysis of the different luxury verticals at Hermes? This is data that other platforms just don't track, even though it's the data that really matters. They've got all of that and literally millions more data points. And unlike legacy equity research platforms, Fiscal AI's data is real time, so it's updated within minutes of company earnings reports.
And Max, there are so many more features, including earnings calls, transcripts, financial modeling, best in class charting, portfolios of super investors like Stan Druckenmiller and Chris Hone, and they even have an easy to use data API so you can export data and build your own models in Excel. Fiscal AI is changing the way investors conduct equity research, whether it's individuals like us or institutional investors like Van Eck, who have their whole research team on the platform. But don't just take our word for it. Sign up for a 2-week free trial at fiscal.ai/mm to see for yourself. And if you upgrade, our link will get you 15% off your first year on any of their paid tiers. Again, that's fiscal.ai/mm. Let's get back to the interview. I would say a good deal of this bull market has just been earnings and earnings expectations. So I resist to say that it is the frothy, speculative frenzy and orgy and shameful activity of 2021 when you just had all these horrible companies that didn't make a dime of profit or didn't even make a dime of revenue in some cases going public, and then they'd get unsuspecting or not super sophisticated retail clients involved with those names, and then you just have horrible selling, and people would buy it at 50 and it would be 50 cents. Like I am not really seeing a lot of those IPOs. And I also say, Max, the IPOs that we've seen, now, and a lot of these companies I don't understand, or I'm not saying I love those stocks at all, but they have done well. And when things do go well on Wall Street, Wall Street does it again, and they do it again. So I expect the IPOs to continue to come out, and I think we're going to see a lot more of IPOs because there's certainly a demand for these new issues, and people want them. So Wall Street, the ducks are quacking. Wall Street is going to give the ducks what they want.
On top of that, Jack, usually the best companies go first, right? And maybe there are some people who leg into it first, and then in the maybe first third, you get all the high quality companies, and then it tends to be the lower quality companies towards the end, and that supply overwhelms the demand for new issues, especially as the quality of the companies go. So it's something to look at. Figma, CoreWeave, nobody would say that those are 2021 quality shitcos.
I don't really know. I mean, Corey's business, I think, is kind of like buying and renting GPU demand, which is very cyclical. Now the cycle is undeniably hot, but you could see that kind of thing ending. We'll get onto AI capex in just a second, but I want to say there is a pool of speculative activity. Like there's a headline on Bloomberg just now, Max, about how Anthony Pompliano, I think announced that he was buying Open Door shares, and Open Door stock rallied. Now, that is, somewhat of a peak indicator. When you have stocks going up because people announcing that they're buying, that is kind of a sign of frenzied speculative activity. And Open Door, I mean, I don't think has ever made a dime in net income. Now, maybe it made a lot of money in gross income, but it's net income that counts. This is not VC. We actually know how to do accounting.
I think you're right, but it's important to recognize, like, the size of these companies and that they're not exactly it's just not relevant. It might be relevant to retail traders who are, like, interested in Opendoor and Duolingo and these other companies, and I'm not trying to put Opendoor in the same vein as Duolingo. I'm just saying those are stocks that have been getting a lot of retail attention. But just when you think about them in terms of their market caps and their impacts on the S&P 500 and the types of markets that are globally important, it's barely a drop in the bucket. It's like to compare, like, a little meme coin compared to Bitcoin. Like, they're just like, Bitcoin has global significance and relevance to the financial system. It's a $2 trillion asset. Like, the a coin going from 50,000 market cap to 5 million just, like, isn't important to most people on Wall Street who are controlling big pools of money. Um, and so I just think it's important to, like, when you see these things as an individual investor, it might seem like a lot of money to you, but it's just not even anything close to, Microsoft going up 10%.
Right, Max. And I looked up MicroStrategy, now known as Strategy. The market cap is $100 billion. Let's say that I know there's tons of these imitation MicroStrategies that are their Bitcoin treasury companies, they're ETH treasury companies. It's a stock that buys crypto. Like, why does that need to exist? To me, it seems very likely that that will end in tears at least sometime down the line. Maybe not tomorrow, but let's just say, be charitable and say that the rest of those companies, of that speculative, pool, is $90 billion. So that entire, with MicroStrategy 110, is $200 billion. Like, Nvidia or Microsoft, I think, have gone up more than that in a single day. So goes exactly to your point. Those are speculative activities. Now, I think there's just so many SPACs in 2021 that just drained the most frenetic bulls of their activity and of their capital. I think maybe you're starting to see that happen, but only in a small way.
EPS beats, revenue beats, that's all well and good, but given how important the AI megatrend has been to driving this bull market higher, a lot of people were also keenly focused on the CapEx that's coming out of the big hyperscalers like Microsoft, like Google, Meta, and we saw that. We saw huge CapEx guidance coming out of these companies. Let's take a look at Microsoft.
Hey, Max, so Microsoft absolutely crushed earnings. I believe that was when we recorded a week or two ago. What was expected was $3.38. They delivered $3.57. Interestingly, if you actually look at the chart of Microsoft earnings expectations, they haven't gone up by nearly as much as Google or Meta. But Microsoft is, I would say, the king of capital expenditure on AI capex. Obviously, they're huge in the cloud providers, and they when they buy Nvidia chips and other smart chips, but mainly Nvidia chips, they do that to meet their client demands for AI, cloud computing, for AI. And so it really is how much are they going to spend. So in their, we when we recorded, Max, I gave numbers because they had just reported them, but now the dust has settled. We can actually chart using our great partners at Fiscal AI what the long term revisions are like in terms of AI capex. So now, Max, they expect Microsoft's total capex to be about $90 billion. Interestingly, I actually think so. That's capex, not including AI. They also, in the call on the transcript, talked about their AI capex. I put them at a little over $120 billion, but I remembered. But at some point, they have to moderate their demand. But anyway, this is just basically pure revenue to Nvidia and to a lesser extent, and all of Nvidia's suppliers. But this just goes to show, why Nvidia is up so much. AMD actually, I think, did not have a great quarter. I haven't really looked into AMD that much, but this is basically the companies are betting the ranch on spending so much on AI. I think the revenue is beginning to come in. Many skeptics, Max, say this is a wasteful capital expenditure. They're not going to see the return on investments. I don't really know. I think though that they're definitely their earnings are going up now, and also just to give the Bears some due, like Jim Chanos, ton of respect for him, obviously short seller. He said that their depreciation schedule is too long for these companies. So really, the useful lives is 5 years. So they should be taking a 20% hit in the first year, a 20% hit in the second year, all the way through the fifth year. But really, they're having useful lives of 10 to 12 on the accounting statement. So they're only taking, a 10% depreciation charge on the capital expenditure per year when that should be 20%. So that could artificially boost earnings. So that is the critique from the Bears. I don't know if that's true now. I think I do believe in cycles. Like I do think that will definitely be true at some point, but I don't know if it's true now. But yeah, this AI capex has continued to explode, and so Nvidia earnings is the one company, the big company that has not reported earnings, and will do so in 2 weeks. But I think they're going to do well. The question is how well they're going to do relative to expectations. Expectations are sky high, and they should be. But we'll see if Nvidia can over deliver yet again.
I want to make sure that we don't oversimplify this for people because it is more than expectations. It is more than just a simple, if this is the expectation and we get a beat, the stock is going to rally. And I think Amazon is a good example of that. We talked about it earlier. They beat on revenue, they beat on EPS, but the market did not exactly like what they heard on the earnings call. They gave a wider range of guidance than people were expecting. As well, the cloud revenue growth hasn't been keeping up with some of these other companies. And that means they're losing market share. So Amazon, AWS cloud, like was what powered Amazon. It's why it's, the big tech stock that it is, despite the fact that the marketplace and, prime streaming and all of that is part of the company. I mean, it has really largely been driven forward by its cloud efforts. And if we look at one of the charts that I was pulling up before this from Fiscal was I just wanted to compare the last 12 months, every quarter as a percent change for three companies. So we have Amazon, Google, and Microsoft on this chart here, and Amazon is in the blue. So if you go back to 2022, you can see that Amazon was keeping up with some huge growth. Now, everybody was growing a lot back then. Yeah,
And this is
Google.
cloud revenue. This is the growth year over year of their cloud revenue.
Yes, this is the growth year over year of the cloud revenue from the last 12 months. So if you're reporting Q1, you're going to look back over 12 months and say what was the revenue over that 12-month period. And Google was showing the highest amount of growth, and they have maintained the highest amount of growth all the way through to this last quarter with a 31.1% growth rate. Microsoft has dipped down a little bit, but they're still up at 22.7. Then you have Amazon coming in, and just the growth has really slowed. I mean, at 18.1% growth rate is nothing to sneeze at, but it's not quite keeping up with these companies that have also announced that huge capex. As the demand is shifting maybe to more AI cloud services, you're going to have to invest in the new chips to be able to offer that to your customers. And so if you're not keeping up in market share growth now, and you're not investing as much in having the top of the line stuff that your customers are supposedly going to want, it means you're going to have to spend that later. And I think that's what people were looking at with Amazon and saying, okay, they are not really competing in the same game as these other people. So despite the beats, it's not enough to keep up.
Beating the actual estimate is not a sufficient condition for the stock to go up after earnings. It is a necessary one, but it's not a sufficient one, as we saw on Amazon. Beat on revenue, beat on earnings per share. The stock declined after there. You have to beat actual expectations because the Wall Street expectations, the banks are sandbagging because they want the companies to beat. So it's a nice little PR. That's why 81% of companies beat. Normally it's again lower than that. That's why it's good, but it's kind of a rigged game in uh, uh, for the corporate executives. I think Max that the Amazon revenue growth in cloud, yeah, as you can see, it's growing much slower than Microsoft and much slower than Google Cloud. Just for the folks at home, Amazon was the pioneer of this uh, cloud business model. You pay as you go type model. Microsoft then entered the game, and then Google entered the game later on. So Microsoft, I believe, has now eclipsed Amazon Web Services. So Microsoft is number one, Amazon Web Services is number two, and Google, long time a laggard, is now number three. But Google is growing the most quickly from the smallest base. In the same way, if you just start a company and you have $1 of profit, and then your profit is now $2, like you technically grow and you
Yes.
double your profit. Um, but yeah, Google Cloud, I think for some time was losing a little bit of money, but now it's profitable, and that just makes me think of operating leverage. That makes me think, Max, of Uber. Uber, long decried as a very bad business model. I believed, took very seriously Jim Chanos' arguments, which were right at the time in 2018, 2019. I mean, this company just loses so much money year after year. And then it went public. It continued to lose money. But finally, I think Uber, I don't know well, but I just looked at the operating profit. Like Uber at last is profitable. And it was able to do so because it killed all of its competition other than Lyft and DoorDash on the food. And then it has pricing power, and now it's able to raise prices. And when I was in college, Ubers and Lyfts were extremely subsidized by venture capital dollars and losses. And now those are finally, close to a decade later, leading to actual profits for shareholders. But it certainly took a while, Max.
All right, so Jack, I want to start looking forward instead of looking back. We've got Nvidia coming up. Most of the S&P 500 has reported. Uh, we've got Walmart, which is an interesting company for a number of reasons. Is there anything else you're looking out for in the coming weeks as we finish out earnings season?
Well, Max, Walmart is interesting. Thanks for saying that. I'm no longer short, but I was short Walmart, for a little bit while, just as a hedge during this spring and summer. And because I'm like, it's at 40 times earnings, it's a retailer, and they do have significant importation exposure, aka tariffs. I think so many of these companies, Max, have just masterful supply chain engineers who, okay, the tariff is only 10% from XYZ country, so we're gonna import it from there, and we're gonna do this, and we're gonna manage our inventory, and we're gonna sell everything we have in the United States, and they're able to like forestall the pain for a long time. But I think eventually, if tariffs are actually here to stay at reasonably high levels, then I think they will hurt. So also, it's just like you know, Walmart's if on a great year they're gonna grow their earnings or the revenues 10%, probably less. Let's be honest. Like, what's the risk that it goes to 60 times earnings? Like that's possible, but like I don't see, it's not like being short Nvidia a few years ago when, it can just triple its revenue. Um, and it's at a Walmart is at expensive valuation. So I don't know about Walmart. Will be interesting to see. Um, I do think, yeah, just on tariffs, I think that the your average tariff rate now is about 15%, so higher than the 2% before President Trump took office. But I think and again, now to me, Max, it's obvious, but it was not clear to me, and it was obviously not clear to many market participants also that just like tariffs are paid on goods, not on services, and most of the profits from the S&P 500 come from services, not goods. Like, to now that's so simple, but it's always so obscure and hard to get like during the time. But yeah, I guess I was wrong and everyone was wrong about tariffs. I guess we all had TDS, tariff derangement syndrome. But, I don't know, Max. I do feel like don't you feel like this is gonna be a don't you feel like Walmart earnings, they release it, it's bad earnings, and that was the top? I mean, financial conditions, so easy. Like, what everything is going perfectly, Max, as the earnings are great, but, like, what else can go well that hasn't gone well? You know what I mean? What are your thoughts?
As far as things that could go well that haven't gone well, it would be a turnaround in the labor market, right? Like, we have seen, those 2 revisions downward. If we did have a change at the BLS, right?
Yeah, the woman was fired and the new guy is coming in, yeah.
It's funny that certainly there was commentary about during the Biden administration that the jobs numbers were fake. I don't know. I'm not an expert enough to say one way or the other, but um there is certainly enough doubt in the uh, accuracy of economic data that and you and I actually we went to a conference with the Global Independence Center, and that was one of the topics that they talked about was that data quality around the globe had deteriorated, and specifically that the US is sort of like the world leader in economic data, that we produce so much more granular data for people to look at. And I just think that's a question. And Wall Street is like, I've always had an interest in sort of like these Chinese listed companies here in the US that kind of everybody knows that the numbers are rigged, but it's a greater fool game of like,
Companies? You mean companies, stocks?
yeah, companies that
Yeah.
are listed here in the US where everybody knows that you can't really trust the numbers. And like there was a company that you were talking about with somebody and they were like, "Do they pay a dividend?" And he was like, that's a good indicator that this Chinese, if they pay a dividend, then it reduces the risk that the numbers are completely fake because at least they're paying out something. And we might be at that point where it's like, okay, can we trust the numbers coming out of this person? But if they're really rosy numbers, right? If the numbers are really rosy and the market chooses to say, yeah, we trust those numbers, even if we all now have doubts about the accuracy of the data, like, is it better to just trade with that or trade against it? It's hard to say. So I am interested to see what labor market data we're going to get, how that is interpreted, whether people view it as biased, and even if they do view it as biased, if we all say, but it's a bull market, stupid, so let's buy. And so that is the question. And if you get that, you get good economic data, you get a little bit of rate cut action from the Fed, and then potentially even a new Fed chair coming in who sees things more like the Trump administration. Who knows how much more gasoline we have for the fire.
Yeah, I'm not aware of any economist who doesn't work for the Trump administration who would defend the firing of the head of the BLS because it reported a number that the president didn't like. I mean, first of all, the labor market is very slow moving, so if anything, it shows that issues with the Biden economy. Like, why can't Trump do what he normally does and blame it on Biden? I don't know, but yeah, I do think that the person who is being put in charge of the BLS, I think he is clearly a Trump supporter and and as someone who's actively like working on behalf and being somewhat partisan. And I don't think that is a positive development at all. I hope he doesn't change the methodology at all, or doesn't change the methodology in a way that is going to uh, try and make things look better than they are because I think that's bad. And for what it's worth, I think that the economists at the BLS uh, have a very difficult job of, there's over 300 million people in this country. The labor force is huge. Of course, you have to make assumptions. You're not going to knock on everyone's door. And the response rate has gone down because everyone's online. No one answers their mail. There are a lot of issues. So I reject the word fake if it implies any sort of political bias. I think economists are mostly nerds and they care about the accuracy of the data and of the models. And I think they're working with what they have. So I don't think that's a positive development at all. And of course, the BLS also manages the inflation report, so which was released today. So yeah, President Trump said this was actually kind of funny. He said Goldman Sachs should try and find a new chief economist because Goldman had been quite bearish on tariffs in terms of that they would raise prices. And so far, it shows there's been a limited impact of pass through effects. I think from uh, from tariffs into co- uh, consumers. So mostly, like companies have been just paying the tariff and AKA eating it, so it's been coming out of profits. Um, I will say I think that it is going to take some time, and I also think that tariffs are a tax. So if they come out of profits, they're going to come out of profits. So that can't be particularly good for the stock market. But yeah, overall, I don't know. I feel like there is certainly some complacency. Not a reason to go short, not even necessarily a reason to go underweight, but I definitely think this could be the beginning of a of a bubble. I mean, I just think that I think this could be like, I don't know, maybe the late fall of 2020 when like you start to see the really ridiculous things. I don't think we've seen that many ridiculous things yet.
Well, a big question for me is, will the AI CapEx turn into AI revenue, right?
Yeah.
Not for the chip companies, but for the companies that are supposedly selling the services to other companies. And there's just a lag. There's just a lag in that. The workflows have to be developed, the tools have to be developed, people have to be trained up. It has to be proven out that it's going to improve productivity and improve, the operations of these companies. And you kind of have to bet that it will. That is what people have been betting on, and there's just going to be a lag to that. So we don't really know, and then we also don't really know how that's going to affect the labor market. And so if you have these companies that are getting more profitable, more productive, and not hiring, like normally, I forget who it was that made this commentary, but normally when you see revenue beats, you see EPS beats, you see hiring tick up, and we're just not really seeing that. And
Mhm.
maybe it is because of the way these AI tools are coming in and they're making people more productive. And so I don't know how that's going to work out with um the rates side of things, because if the Fed has a mandate for inflation and they have a mandate for the labor market, if companies are more profitable, they're beating, revenues are going up, but at the same time the labor market is really weakening and they have a mandate that says we're going to have to cut because of this. And so we're cutting interest rates as the economy is running hot. It's not really flowing through to employment in any way. Like, what is gonna happen to stock prices then? And will there maybe be a reassessment of using interest rates as a way um, to control the labor market when there's this other elephant in the room that is really sort of controlling the labor market? That is, I think, one of the big questions to be had, not this quarter, not next quarter, but over the next few years. And, when we talk about bubbles, I mean, they are often multi-year types of things.
I think you'll be in the middle stages of a bubble. You will be truly in it when you see companies with no fundamental earnings power or improvement in earnings power going to the moon, and it is the worst companies that are going up the most. We really haven't seen that. Like, it's been Nvidia, the company that's gone up the most, and their earnings have gone up the most. Palantir has gone up a ton. Their earnings have gone up a ton. Now, Palantir is an extremely, extremely richly valued stock. And I think, like, just historically, if you have a stock that's over 100 times earnings, or many, many, many times sales, like, really it doesn't work out well, even if the fundamentals continue to improve. Like, just look at Snowflake. So I urge caution for Palantir, but I would have said the same 2 to 3 months ago, and clearly I was wrong. Um, yeah, I'd say, Max, I think we can call this like episode like Wall Street crushes Main Street, because I think all of the improvements in the economy, what's contributing to GDP and corporate profits, is AI CapEx, and that inherently is benefiting a small number of companies and a relatively small number of people. Like, you see the headlines about people being paid literally $1 billion to join Meta to be an AI researcher, and I think that the gains from this economic cycle are normally abnormally slim. And, like, yeah, if corporate profits, as in the S&P 500 profits, are up 12% year over year, and wages are up 4 to 5% a year, that's not sustainable, and I don't think it's good for the long term health of the economy and society. But it does mean in the short term the stock market's going to go up. Should we
Yep,
end it there, Max?
for sure. Thanks, Jack.
All right. Thanks everyone for watching. Remember to check out today's sponsor, Fiscal AI. I really, really like their products. By the way, they've got this tool where you can track super investors. I'll just name something. I actually do own a few shares of the stock. Verisk Analytics, it's an insurance data provider, and they do a lot of tools. At first, it went on my radar because I am really interested in Markel, kind of a baby Berkshire type model, and their CEO, Tom Gaynor. You can track his portfolio on Fiscal AI. And before I even knew what Fiscal AI was, well before they became a partner of ours, I used the Fiscal AI tool to see what their holdings are, and I tracked Verisk Analytics. I'm like, okay, this insurance company that has a multi-billion-dollar portfolio, they're buying Verisk Analytics. That's interesting. Now, actually, I'm down like 20% on Verisk Analytics, so it's one of the few stocks that's not going up. But I don't know. I think that this tool really, if you're a real investor who likes to do the work and do research and see fundamental analysis, and then you could just to get ideas. They've got a great screener as well, but like, see what other people are buying and track it over time. Fiscal AI really is a great tool, and I'd say I love the product, and I think people can. A lot of people watching us will as well. So we've got a link. People can click the description, check it out, and obviously leave a rating review for Monetary Matters, as well as Max's podcast, Other People's Money. Until next time. Thanks for listening. Looking to check out Fiscal AI's innovative equity research terminal? Get your 2-week free trial and 15% off your first year at fiscal.ai/mm. Until next time.
Thank you. Just close the door.